I'm Howie Lim. This is Money Hacks by the Business Times.
We believe this is the time for fixed income to have a comeback. We see high probability for yields to perform next year. For Asia specifically, we like the high-yielding local currency bonds given their very competitive yields on FX volatility characteristics and the stage of the economic and monetary cycle.
So far, we've seen Asian high yield as a key outperformer in both the local and global fixed income context. The year-to-date return is about 8%.
Asian fixed income has had a good year so far, performing significantly better than its global peers over the first 6 months of 2024. And Asian bonds attracted foreign inflows for a fourth successive month in August on optimism that the US Federal Reserve would start easing interest rates in September. We know how that went, but foreign investments in Asian bonds then decelerated in September as US rate uncertainties and a strong dollar influenced investor behavior. Then they went risk-on with Asian bonds after that jumbo US rate cut in September, and who can forget the Asian international bond market being on fire at the end of September as a range of issuers raised large sums, many of them at negative new issue concessions. Phew, not for the faint of heart, but don't take my word for it. Welcome to Money Hacks, a podcast series by the Business Times, where we explore useful financial tips to help you on your money managing and wealth growing journey. I'm Howie Lim. And hey, if you have feedback or an idea for a podcast episode, do get in touch, btpodcasts@sph.com.sg. And helping us out today to figure out if Asian fixed income still has it, so to speak, is Navin Saigal, Head of Fundamental Fixed Income Asia Pacific at BlackRock. Navin, thanks for joining us.
My pleasure.
Talk us through what's been happening with Asian fixed income so far, from your perspective. I mean, we're recording this at the end of October.
Yeah, well, we're in an exciting time for global fixed income markets, and especially so in Asia. Over the last 2 years, I think, it's important to put this in context. Over the last 2 years, we've seen a reversal from the prior 2 years, right? And we've had two particular headwinds in Asian markets, one being a very high US policy rate and the other being a very weak Japanese yen. Because of these two headwinds, central banks in the region were unable to cut rates for fear of currency weakness. A lot of countries in this part of the world have explicit baskets of currencies that they manage to. And the yen, and I would add the yuan, are two very large components of those baskets. So when the basket is weakening, it's hard for Asian central banks to cut rates. They have to keep rates high in order to keep capital local. In the last month or two, we've seen both of those headwinds turn into tailwinds. On the US side, the Federal Reserve has cut rates by 50 basis points last month in September and is likely to cut another 25 next month in November. At the same time, the Bank of Japan hiked rates, strengthening the yen. Both those headwinds have now become supportive of flows back into Asian markets, and I think that's one of the big reasons we're seeing these markets perform.
Are there sectors and countries that are really exciting, currently offering, say, the best yield opportunities? I mean, Asia's huge, to be honest, and we're also hearing Southeast Asia's in the mix as well.
We think it's the golden age of fixed income, the golden era of fixed income globally, because it is a target-rich opportunity set. Almost everywhere you turn, you can find an opportunity, starting with treasury yields, which are at roughly the highest in 17 years, call it more than 15 out of the last 17 years. And going more local into the region, we've got India, Philippines, Indonesia, a handful of countries where the government bonds, the supposedly safest asset in that country, is also in this, really juicy yield range of about 6 to 7%. And on a 6 to 7% yield, even if you assume 3% inflation, which is higher than most people's targets, you end up with about a 3 or 4% real yield. So compensation in addition to inflation. Going into credit, you can just add on a little bit of spread and end up with a 7 to 8% yield. This is not just in US credit, US high yield, but also in Asian high yield. To pick one specific example, Indian renewables. You've got a country where there's a national agenda towards a push towards renewables, And I think there are many opportunities to lend into these markets and generate a healthy yield.
Yeah, that's the scuttlebutt as well. At about 7% yield and a duration of 6.5 years, Indian government bonds offer a compelling yield pickup over its emerging markets peers. In fact, Indian government bond yields remain mostly steady at just under 7%. So how should we be rejigging our portfolios? I mean, 6 to 7% yield is compelling for sure. More with Navin Saigal from BlackRock in a moment.
If you've been a fan of the podcast Mark to Market, Wealth BT and Property BT, they are moving to a new listing, BT Correspondence. Look for episodes every Tuesday from October. All the insights and analysis and market trends, property, wealth, and soon mobility too. Powered by the Business Times journalism of Genevieve Kwa, Leslie Yee, Ben Paul, and Darren Wong. Because great reads should be heard. The BT Correspondence channel. Find BT Correspondence wherever you listen to podcasts.
And now, back to Money Hacks from the Business Times.
Navin Saigal, Head of Fundamental Fixed Income Asia Pacific at BlackRock. Navin, would you say that we need to adjust our portfolios now that things are changing? But things are always changing, right? How should we be adjusting our portfolios then to navigate the easing rate hikes that you talked about and the easing policies from central banks as well, particularly in Asia and the US?
I think at the margin, it is worth putting a bit more of the portfolio into fixed income to try to lock in these higher yields. Having a 6 to 7 in 8% in some cases income stream, it's quite a rare thing to be able to get that kind of income stream. So we think, for 3 to 4, maybe 5 years to lock in these levels of yield, this kind of income, it's a rare and unique opportunity, and it should be taken advantage of. So we're tilting our portfolios in favor of fixed income over equity at a time when equity valuations are generally quite high. I think yields in Asia have actually struggled to keep pace with developed markets. In the cases where they are higher, they are only very slightly higher. But then there are a number of countries where yields in Asia are actually lower than in developed markets. That's part of the reason for those headwinds around flows that I mentioned earlier. But one important thing that has also happened in the last 4 or 5 years is that economies globally have become desynchronized. I'll use Asia and the US as one example. Around COVID, the pace of lockdowns and restarts created completely desynchronized economies with different inflation cycles, different growth cycles, different monetary policy cycles, and indeed different fiscal cycles, depending on each country's individual policy response. We've ended up in a place here where the bond market in Asia is completely uncorrelated to the bond market in the US. And that makes for a very attractive diversifier in global fixed income portfolios. So despite the lack of risk premium in the yields over here, we like that diversified characteristic of Asian bonds, and we're still adding.
Investing 101, right? Be diversified. Mm-hmm. What about if there's anything on the horizon that could sort of derail how well Asian fixed income's been doing so far? Because we've got one coming up. Want to guess which one? Bearing in mind we're recording this at the end of October.
Certainly. I'd say the two biggest risks for fixed income investors today, or investors in general today, are reinvestment risk and event risk. Both of those happen to have new information next week. I'm saying this ahead of the US election. And the day after the election, there is an FOMC meeting, a Federal Reserve policy meeting. On the election front, I'm sure that most people have their views, but the one that's relevant for Asian markets is probably the trade front. So in advance of that, we are, kind of keeping a little bit of cash handy in order to take advantage of any market dislocations that could come from, potential surprise policies from the election, specifically around trade. But we are careful not to raise that cash buffer too high, because then you run into that second risk, right? Reinvestment risk. With cash rates coming down, most likely another 25 bips is what the market is pricing at next Federal Reserve meeting. There is a lot of cash around the world that is trying to get put to work to lock in higher yields, higher income streams, before yields become too low. So we're trying to balance both of these risks, event risk and reinvestment risk. So we want to hold a little bit of cash to take advantage of market dislocations, but not too much.
So will these two big things, the US elections and the FOMC meeting, affect at all how the outlook for Asian fixed income will be for the next, say, 18 to 24, Navin? I mean, we're not supposed to listen to the noise, so to speak, but the narrative and weak stomachs of market players tend to affect things.
I don't think so. If you extend the horizon to 18 to 24 months, that income stream that I talked about, that 6 to 7%, I mean, that pays a lot of bills. You can ride that, carry through that. And I think, one of the biggest mistakes that many investors tend to make is trying to time the market and trying to time events. I'd say even the best investors in the world, they only have about a 55% hit rate in terms of getting the timing right in their investments. That's just slightly better than a coin flip. So really the way to beat the market is to benefit from, these themes like compound interest, compound returns. These are very powerful tools that can benefit someone who's saving for retirement, get the capital markets to work for you. And to do that, really, I go back to this old saying that time in the market is more important than timing the market. So I would suggest for the average investor and even for the good investors that staying invested is more important than trying to get each specific risk right.
I like it. Sounds like clear skies ahead, more or less, for Asian fixed income. Thanks for the advice, Navin.
My pleasure. Thanks for having me.
Navin Saigal, Head of Fundamental Fixed Income Asia Pacific at BlackRock. And don't forget to send us an email if you had feedback or an episode idea, btpodcasts@sph.com.sg. I'm Howie Lim, and this has been Money Hacks from the Business Times.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts. Or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.